Okay, welcome to the Chapter 5, Transactions that Affect Revenue, Expenses, and Withdrawals presentation lecture. Please make sure that you have gone into Google Classroom and downloaded all of the materials that you will need as we go through the Chapter 5 material, any notes and or demo problems that might have been posted. All right, Section 1 of Chapter 5 is going to deal with the relationship to revenue, expenses, and withdrawals and how it affects owner's equity. When we deal with, let me go back a slide, when we deal with revenue, expenses, and withdrawals, those are considered to be temporary capital accounts, which means indirectly those accounts are going to affect the balance of the capital account. Temporary capital accounts are going to start with new each accounting period, and it's going to have a zero balance to start. So at the end of each accounting period, these accounts are going to get zeroed out, and then at the starting of the next accounting period, they begin with a zero balance. To reference this, please take a look at page 97 in your textbook. That is going to display how the temporary capital accounts, such as revenue and expenses, are zeroed out for the beginning of the next period. Now, examples of temporary capital accounts: utilities expense. One common mistake that a lot of accounting students will do is they will they will forget to put expense on. Now, utilities is not the account. You have to include the expense so that we know the classification of the account. So utilities expense, advertising expense, rent expense, all examples of temporary capital accounts. Permanent accounts, these are accounts that do not get zeroed out at the end of an accounting period. These are accounts that are continuous from one accounting period to the next, which means the balances are going to carry over from each accounting period. Balances at the end of the year become the new balance at the beginning of the next year. Examples of permanent accounts are supplies, asset account; equipment, asset account; cash in bank, also asset account. For revenue accounts. Revenue qualifies as a temporary account. Revenue is cash coming in. That is money that we will be receiving. It is going to have an effect on the capital account. Revenues are temporary. The revenue account is increased on the credit side. So picture a revenue in the T account. If you credit the account, which means that you list a number on the right-hand side, you will increase the value of the account. Therefore, the credit side is the balance side. If you decrease the account, decrease revenue, you would debit the account. Increase credit, decrease debit, normal balance side, credit for revenue. Revenue earned increases owner's capital. Please see the example on page 99 to see how those two accounts impact each other. Revenue recognition. That means to recognize revenue on the date earned, even if no cash has been received. So when we transact these accounts, we have to go off of the date of recognizing the revenue and not on the date the cash is earned. All right, for expense accounts. Expenses are also temporary accounts that will impact the balance of capital. They are increased on the debit side, which would mean the debit side is the balance side. They are decreased on the credit side, normal balance, debit. Increase, debit, decrease, credit, normal balance, debit. Those are the rules for expenses. Expenses will decrease owner's capital because that is money that has to be paid or has been paid. You can see an example of this on page 100. Of the withdrawals account. Withdrawals also a temporary account. Withdrawals are increased on the debit side. They are decreased on the credit side. And the normal balance is the debit side. So increase, debit, decrease, credit, normal balance, debit. Withdrawals is also commonly called a contra capital account because it is a capital account with the exact opposite properties of the capital account. Withdrawals decrease owner's capital, and that is illustrated on page 102 of the textbook. All right, let's take a second and think critically. Changes to a revenue account affects another account. What account is affected and why? Think about this and answer the question because we will be touching upon this more when we meet next time in class. What type of transaction affects the debit side of the owner's capital account and why? Again, questions you want to think about and answer because these are the things we're going to be going over with class examples and exercises in class next time we meet. Moving on to section 5.2, applying the rules of debit and credit to revenue, expense, and owner's equity transactions. All right, let's take a look at a couple of T-account transactions. On October 15th, Roadrunner provided delivery services for the Sims Corporation. A check for $1,200 was received in full payment. We have the two accounts that are affected, cash and bank, and delivery revenue. Now, because it was money that was received, we are going to debit cash and bank and increase it $1,200 and credit revenue and increase revenue by $1,200. On October 16th, Roadrunner mailed check 103 for $700 to pay this month's rent. In this case, cash and bank and rent expense are affected. You should get into the habit. Don't have it this way in the presentation lecture, but you should get into the habit of always listing the debit account first. So rent expense would be the debit for $700, increasing its balance, and decreasing cash by $700 by crediting cash and decreasing its balance. On October 18, Beacon Advertising prepared an advertisement for Roadrunner. Roadrunner will pay Beacon's $75 fee at a later point. So as accounts payable Beacon, we're not paying it up front and advertising expense. Increase accounts payable by $75 because we owe them that money, and we will increase the value of our ad expense account by $75. Debit advertising expense, credit accounts payable Beacon. On October 20, Roadrunner billed City News $1,450 for delivery services. Accounts receivable City News, they are a customer. They owe us money, but we haven't collected it yet. Then delivery revenue. We are going to debit accounts receivable City News for $1,450 and credit delivery revenue for $1,450, increasing the value of both accounts. On October 20, $125 telephone bill with check 104. Cash bank and utilities expense are the two accounts affected by this transaction. Utilities expense will be debited and increased by $125. Cash and bank will be decreased and credited $125. On October 29th, Roadrunner wrote a check for check number 105 for $600 to have the office repayment. Cash and bank maintenance expense, the two accounts affected in this transaction, a decrease in cash by crediting the account for $600, and an increase in maintenance expense by debiting the account $600. On October 31, Maria Sanchez wrote a check 106 to withdraw $500 cash for her own personal use. The accounts affected by this transaction, cash and bank, and Sanchez withdrawals. Cash and bank will be decreased by $500, which will be signified by a credit to the account. Sanchez withdrawals will be increased by $500, which is shown by debiting the account. Now, at the end of any group of transactions that have been logged, testing for the equality of debits and credits is key. It can allude you to any problems or any mistakes that were made in the accounting process. What you need to realize by looking at page 108 in your textbook, debits must always equal the credits. So every transaction must have the equal amount for debits as for credits. In order to do this, what you want to do is make a list of all accounts. List the balance of each account using the two columns, one for the debit balances and one for the credit balances. Then simply do the math and determine whether or not the numbers in each column equal. All right, let's take us a second and think critically. What is the normal balance of a withdrawal account? Hopefully you can answer that. We'll be going over that more when we get to our next class period and go through some examples. What other temporary account carries a normal balance on the same side as the normal balance of withdrawals? Remember, we went over 3 temporary accounts in this presentation lecture: revenues, expenses, withdrawals. What permanent account do the 2 temporary accounts above represent? And that concludes Chapter 5 presentation lecture. Please make sure to revisit any of the slides if need be, and I will see you next time we meet in class.